QuickBooks Pro Plus Desktop 2022 OneNote Presentation Bill Form. Let's get into it with Intuit's QuickBooks Pro Plus Desktop 2022. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon left-hand side, Topic Introductions tab, down in the 1180 Bill Form tab. Also note, when using OneNote, take a look at the Immersive Reader tool. Topic introductions, they're also in the text area, same name, same number, but with transcripts. Transcripts that can be translated into multiple different languages and either listened to or read in them. The topic introductions will also have the same name and number as a presentation. Topic introductions designed to give an introduction to the topic, provide screenshots and links where applicable, as well as give the accounting background that could be supporting what we will be doing in QuickBooks. Closing the tab on the left-hand side, we're looking into the bill form. We're going to start out with some screenshots of QuickBooks. You can use these to follow along with the presentation in QuickBooks if you would so choose, instead of having the software open. Then we're going to get into the accounting basically being the behind-the-scenes activity that could really give you a better idea of what is going on within the QuickBooks system, which will help you to populate forms like the bill form, but it will also help you to be able to set up the bill form and see when there's going to be problems with it so you can troubleshoot those problems. So first we'll go over the screenshots basically from the QuickBooks for the bill form. We start off at the home page. We're looking at the vendor section. We're focusing in on the bill form. That's going to be the form that will increase the accounts payable. The other side then going to an expense account, inventory account possibly, or possibly a fixed asset account. If we open the bill form, it looks something like this. I'm going to scroll down one more time to a little bit of a closer look. Looks similar to a check, but the bill form means that we're increasing accounts payable instead of decreasing cash. We still have the vendor, as you would expect with a check, a date, the amount. Down below, we either assign an account on the expenses side, which would be either an expense account, utilities, telephone, for example, or we would assign possibly an asset account if we purchase a large item, such as property, plant, and equipment. The second tab, being the items tab, we're going to populate the item, which will also allow us to track the inventory item, not just by account, by the inventory account, by dollar amount of the item, but also by the item type. That's why we need this extra section. This bill form will allow us to populate the bill as easily as possible if set up properly, especially if we have these items, which could be a little bit more complicated. And then this bill will then create the journal entry, which will basically increase the accounts payable. And then the other side will be assigned by these items below, either an expense account, asset account, or inventory account. Now let's take a look at a journal entry just for an example of it. So here's where we're going to get into the accounting. We're going to talk a little bit about debits and credits. Even if you do not understand debits and credits, it's good to get a little bit of an idea of it, and you can see how the accounts are affected in either case, and you can think about it in terms of increases and decreases to the account and get a feel of the behind the scenes of what's happening in the QuickBooks software. Because note, what we really do in QuickBooks is we enter the data, then we go right to the end result, which has been populated automatically through QuickBooks, and then we drill back on what has actually happened by going to the source documents from, say, the balance sheet and the income statement. Now let's take a look at going the other way, seeing what happens when we create something like a bill to create the balance sheet and the income statement. That's the accounting behind that QuickBooks is doing for us. So the journal entry for a transaction like this, like a bill, it's not the same amount, would be, let's say we put in a bill for like the utilities bill. It would be that we would then debit the utilities expense and credit the accounts payable. Now you could think of this as simply an increase to utilities, and the accounts payable is increasing as well. The debits and credits, we're debiting the utilities because utilities is an expense account. The expense accounts always go up accounts always go up by doing the same thing to them. So a debit will increase a debit account, and the liability accounts will always go up with a credit because they're credit balance accounts. So if I was to post this out to say a trial balance, this is going to be our beginning balance laid out, balance sheet on top of the income statement. So here's all my balance sheet accounts. Green ones are the asset accounts. Orange are the liability accounts. Dark blue are the equity accounts. That's where basically my balance sheet stops. Then I have the income statement right under it. sales and the cost of goods sold. Sales is income, revenue. It's a credit, which can kind of throw people off a little bit if you don't understand debits and credits, but it's a credit there. And then the debits are represented down below with all the positive numbers down below for the expense accounts. Then we can see that debits and credits are in balance with this green zero down below. This is net income in the form of a credit, which is the $200,000 minus all of the debit accounts, which are the expense accounts, getting us to the net income. So this will give us a really quick look at what is happening from this transaction up top, which would mirror what happens with a bill. So what would happen from the accounting standpoint, if utilities was debited, we could see that down here. We would say, okay, there's the utilities account, has a debit balance of $1,900. It would go up by debiting it, doing the same thing to it of the 500, taking it to 2,400. So we increased the expense account. That decreases net income, because net income is revenue minus expenses. This is income, not a loss. The brackets mean credit, not a loss. 24,710, and then we have the 500 minus the expense of 500 gives us to 24,210. So it has an impact on the income statement account on the bottom line of the income statement, which is net income. The accounts payable started in our example at 1,600. We credited the accounts payable, increasing the accounts payable by 500. Now this shows credits in brackets, so you could think of that on the number line as it going down on the number line, but in terms of debits and credits, it's going up in the credit direction from 1,600 by 500 to 2,100. So that's just the two accounts that are affected. Net income is affected, even though cash has not been paid at this point in time, because the accounts payable is an accrual type of account. This 2,100 now represents something that we owe to vendors. I need to break that out not only by the GL by date, but also by subsidiary ledger. If I was to look at the general ledger, it would look something like this. The accounts payable had a 1,600 starting point. I'm going to list out the activity that we have happened now by date. This happened on 1/15. We credited the accounts payable, increasing it to 2,100. On the utility side, if I looked at the general ledger, we started at the 1,900 debit, increased it with a debit, because we're doing the same thing to it, 500 to get to the 2,400. These two items we can call the general ledger, the GL, which you can think of as basically the transaction detail report when you think about the QuickBooks system, when you double click drilling down on a balance sheet account, for example, to the data underneath. You're usually going to a transaction account by date. It means you're backing in to the data and getting into the source, or going towards the source of the data, because that's how the data was actually created. The data was created with a bill. The bill made basically a general ledger account generally. The general ledger accounts created a trial balance in essence. Trial balance then created the balance sheet and income statement. When we work in QuickBooks, we go from the data input bill directly to the end result, the financials usually, and then drill back down to the process that created it, drilling down to the general ledger transaction detail report, for example. So then we also need to break this out by the subsidiary ledger, which is the accounts payable subsidiary ledger in this case. This is breaking it out not by date, breaking out the accounts payable by vendor. The reason it's a subsidiary ledger is because the total of it, if I was to add up all four of these vendors, would need to add up to the same amount that's on the general ledger, the 2,100 that we have populated here, which is on the trial balance, which would also be on the balance sheet. So this is going to be important, and again, it's done automatically in QuickBooks, because QuickBooks actually forces us to enter a vendor every time we enter something to the accounts payable account, because QuickBooks is saying, hey, I have to have a vendor so I can populate the subsidiary ledger. So in this case, we're going to say that this is vendor 4 that we paid, I think it was utilities for or whatever. It's going up by that 500. So now we owe this vendor $500. We have 4 vendors now that we owe money to. If we add up those 4 vendors, it adds up to 2,100, which has to add up to, due to it being subsidiary ledger, the accounts payable amount. So now let's take a look at, if we take a look at the balance sheet, the financial statements. Here's the financial statements after that transaction. Normally, if I was to do this in QuickBooks, we would take the end result, we'd enter the data, go to the end result, for example, and then drill back down, say, on accounts payable, getting to the transaction detail, which would look something like this, a general ledger. And then if we drill down on the general ledger, we would then get to basically the journal entry, which would really not be in the form of a journal entry, but rather in the form of a bill if we were talking about the way QuickBooks would be doing its data input. So then let's go on down to the next thing we might see in QuickBooks. This is the transaction of the bill that we were taking a look at in the QuickBooks system. You can actually look at the transaction journal, which is going to be like the journal entry that is created from the bill. You can see there's always going to be two accounts that are going to be affected. Accounts payable in this case, and it went to a job number because we were looking at a job cost system. If you go to the balance sheet, you would be taking a look at the accounts payable account, and this is within QuickBooks now, a screenshot of QuickBooks. This would tell us how much you owe to somebody. If you drill down on it, you'd get the transaction detail account, this being similar to, like we saw in the accounting standpoint, the general ledger, breaking out the items by date. This gives you more detail, however, because it also gives you the bill type. Notice there's only two types of things that are impacting the transactions, a bill and then the pay bill. So you can know exactly what's going to happen with the accounts payable account. We're going to increase it with a bill, and then eventually we're going to pay the bill. So that's going to be our transaction detail. The profit and loss account, we could see down here, the account that was affected was an expense account, I believe, with the bill that we were taking a look at, or that's often or commonly the account impacted. You can see if we drill down on the income statement side of things to the job materials, it's going up with a bill as well. That's impacting the income statement and net income. Let's take a look at another one. So here's an example of a bill that would entered. Let's take a look at it from an accounting standpoint. This time we're thinking, what if we purchased equipment? So normally when we entered this bill last time, we assumed from the accounting standpoint, we entered an expense, utilities expense, which from the bill side in QuickBooks would be over here on the expense tab, and then just selecting the accounts for utilities. This fact that they named this expenses makes you think that only expense type of accounts can be affected here. However, that's not true, because you might purchase like something like an asset, like equipment, a large piece of equipment that you're not going to expense, but rather put on the books as an asset. So if that happened, you same kind of process, you just put it on the books as an asset. It would look something like this. We would debit the furniture and equipment. It's an asset account going up with a debit. The other side, just like normal with these accounts payable accounts, because it's still a bill type form, increase in the accounts payable representing that we owe money in the future. If we started with our beginning balances over here on the left-hand side, or started where we were last time, and then we post this transaction, we would increase the furniture and equipment up top, which was at $16,000, increasing it by $5,000 to $21,000. So now we've increased that. It did not affect then the net income. This $5,000 was from the last bill we entered. So no impact on net income because this is a large piece of equipment and we're going to impact income when we depreciate it in the future. That's one of the differences that you would see. The other side then, accounts payable, increasing the accounts payable. We started at 1,600. We increased it by 500 last time, this time 5,000, increasing it by a total of 5,500 between the two transactions to get to the 7,100 increase in the accounts payable, representing what we owe to third parties. That 7,100 can also be broken out with the accounts payable general ledger. That would be similar to us like double clicking on the account on the balance sheet to see the transaction detail by date, which would be 1,600. Then we increased it by 500 to 2,100, increased it by 5,000 to 7,100. That matches what's on the trial balance and or what would be on the balance sheet. Also, the furniture and fixture went up on the transaction detail or the general ledger GL type of account. 16,000 increased by 5,000 to 21,000. So then we'd also want to see the 7,100 broken out by who we owe the money to, which is a subsidiary ledger, which in QuickBooks might be called something else. An aging report is a type of subsidiary ledger, and a transaction by vendor report would be a type of subsidiary ledger, it being subsidiary because the total of it needs to add up to the amount on the ledger for accounts payable. Therefore, it's subsidiary. It's just reordering the order of them. This is by vendor. So we're going to assume vendor 1 here. This is who we owe the money to, like Office Depot. went up from 700 by 5,000 to 5,700. Adding up these four vendors now, the only vendors that we have, adds up to that then 7,100 broken out by who we owe the money to. So then if we take a look at one more example, this would be the most difficult one, or that would be that we buy the accounts payable, we enter a bill, this time wanting to purchase inventory. The reason this is more difficult is because if you did this in QuickBooks, you would also need to assign, just like the accounts payable needs a subsidiary ledger by vendor, you need the subsidiary ledger for inventory that's just going to break it out by the type of inventory so you can track the inventory units too if you're tracking it in QuickBooks. Therefore, you cannot just assign an account like inventory, but rather have to set up the items, which can be somewhat tedious to do in QuickBooks, bit of a challenge. We'll talk about that later in the second half of the QuickBooks course. But here, that's what you have to do in QuickBooks. We'll get an idea of that, putting it here in our accounting format. So the journal entry would be straightforward. Again, we would debit this time the asset of inventory instead of expensing it because we have not yet used it in order to generate revenue. We will expense it in the form of cost of goods sold when we sell the inventory. And then the other side is going to accounts payable just like normal with a bill type of form. If we enter this into our trial balance, we can now see the inventory, which started at $4,375, went up by $1,000 to $5,375. And our accounts payable from the three transactions now went up by $500, the $5,000, and the $1,000, total $6,500 increase from the starting point of $1,600, getting it to $8,100. The general ledger then for accounts payable started at $1,600, increased with a bill type of transaction by $500 to $2,100, increased with another bill type of transaction, $5,000 to get to $7,100, increased with another bill type of transaction, the latest one, by $1,000 to get to $8,100. Asset inventory account went from $4,375 up by the $1,000 in the debit direction to $5,375. This accounts payable we can break out then once again by the subsidiary ledger broken out by vendor. This time I'm going to say vendor 2 was the vendor that we purchased from. So we added this. It started at $300, increased by $1,000 to $1,300. Adding up the totals of all our vendor, of which there are 4, gives us a total amount up top of the $8,100, that then tying out to the general ledger amount. Similarly, we'll take a look at the inventory subsidiary ledger. The inventory subsidiary ledger is going to look a little bit different. I'm not going to break out or think about get into too much detail right now on tracking inventory, but you have to assume some kind of flow assumption or specific identification. A flow assumption like FIFO, LIFO, or the weighted average. QuickBooks will typically use a weighted average if you're defaulting with QuickBooks Pro. So that's what you might want to think about there. I won't get into the flow assumptions a lot right now because that's a whole topic in and of itself. But the general idea then would be we started with some inventory in terms of units and the unit costs that we would have to quantify in some way so we could put it on the financial statements at the cost while still having backup or supporting data that's tying out to the unit cost, the cost per unit. And we need a flow assumption generally to do that. So for example, here we've got the item 1 and item 2. These are going to be the inventory units that we're selling, whatever widgets we're selling, the inventory units. Now we started off with 50 units times a cost of 50 for 2,500 at the beginning on unit 1, unit 2, or this other inventory item, the other kind of inventory. We had 75 of those at $25 or $1,075. Here we're going to say that we purchased in the purchased column units, 20 units at $50. Therefore, we increased it by the total of the 1,000. And if I pull that up to my ending inventory, what does that mean? That means we started with the 50 plus the 20. We've now got 70 units. And now we've got a cost 2,500 plus the 1,000. There's the 3,500. The unit cost on a weighted average is still 50 because we didn't have a different cost here, so we don't have to do anything tricky with the averages. So I won't even need the calculator. We got the 3,500 plus the 1,875 of the other units. That adds up to the 5,375. Now I know I went over that quickly. I'm not trying to focus too much on the inventory at this point. What I'm trying to just focus in on here is the fact that when you enter a bill and there's inventory involved if you're tracking the inventory, QuickBooks needs to do this added piece. And in order to do that added piece in accounting software, you will typically need to use items to do that and put in specific information related to the items. And like with the accounts payable, QuickBooks requiring, or accounting software typically requiring, a vendor, then when you hit the inventory account, you don't want to post anything directly to the inventory account without assigning an item to it, so that the system can then do the flow assumption and assign the proper flow assumption and create the subsidiary ledger, which should always tie out, due to it being subsidiary, in total dollar amount to the general ledger. So then if you looked at your balance sheet again, it should all balance out here. If we entered these transactions, then we would be going to something like the accounts payable account. Usually in QuickBooks, we'd enter the bill, then you go to the financials, and then you often drill down on the financials going from the 8,100 possibly to the general ledger to see the activity by date. And then you might say, hey, I need another report to give me that information by vendor, which would be a subsidiary ledger of types. Within accounting software, it might be called some kind of aging reports, accounts payable aging, or vendor balance detail report. And similarly with the inventory, you see this, you might drill down on it to get the inventory by date. Then you might then say, hey, I need another report, an inventory subsidiary ledger, which might be called something like an inventory summary report, inventory item summary, or something like that. So if you saw the whole process then, and like if we were going to enter this information from start to finish in like an accounting system, doing what the computer does behind the scenes, you would say, okay, I'm going to put my journal entries in here. And then usually you would think about actually creating or posting to the general ledger is the next item. And then the general ledger would then be used to create the trial balance here. I'm using the trial balance as a nice transparent showing to show a few transactions within the trial balance. That's why I'm showing that first. But traditionally the GL would be created next, then the trial balance, and then the trial balance would be used to create the financial statements. And the same data that has been used to create any accounts that need a subledger, then you'd create the subledger for the accounts payable, for example, and then the accounts receivable, when necessary, the subledger for inventory. Then you would use that trial balance in order to create the financial statements, the end result. This is why the financial statements are the major reports in accounting software like QuickBooks. All other reports are really subsidiary, giving you more information about some item within the balance sheet and the income statement. So you got the balance sheet, you got the income statement, statement of equity. That's how the flow goes with the actual creation of the reports in accounting software. And then how you use it in accounting software typically will be enter the data with some type of form. The financial statements magically appear. Then you try to figure out what happened by then investigating, going to the end result after it has been done, drilling down on something like the accounts payable, which will then take you to a general ledger type of account, say over here, taking you to the GL account. And then you're going to say, that's interesting, but I want to see it sorted a different way. Is there some other report, which would be like a subsidiary report, which would give me the same balance, but tell me who I owe the money to? That would be the AP aging report, or the vendor balance detail report, looking something like this. And then you'd go to that information, and so on.